Good afternoon. Welcome to Midcap Radar live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Where we started above the 25,000 mark. We continued on those levels as well, but now slightly off from the highs of the day. We are at the 24,966 mark. But yes, nothing to complain so much because there has been some development as far as US-India tariff talks are concerned. We'll see which way things go. But for now, in the green, but off the highs.
In the green of the highs. So the trade truth is something that the street is looking forward to, and that's clearly keeping the markets quite buoyant, and the broader end of the market is doing much better compared to the benchmark indices. Well, a lot lined up on the show, some important corporate conversations as well. Let's start off with the top headlines. A Trump and Modi exchange on continuing US-India trade talks lift market sentiment. IT and PSU banks clock gains, while auto and consumer durables tracked. Mid-caps gain.
As India-US trade talks get back on track, export-facing stocks like Bharat Forge and Vardhana Motherson signs surge. Stocks gain between 2 to 4%.
Stocks of exporters of shrimps and other marine products rally after the Commerce Ministry says EU will open up its market further, leading to an immediate 20% increase in exports. CLFMA India tells CNBC-TV18 that if exports open up to EU, there is an opportunity of $1 billion.
Urban Company's 1,900 crore rupee IPO gets fully subscribed on day one. CEO Abhiraj Bhal tells CNBC-TV18 the company aims to continue growing at the same clip and it is nearing break-even.
Good luck India tanks in trade after it cuts its FY26 guidance. The management tells CNBC-TV18 that they earlier expected 20% top-line growth, but now see only 12% amid uncertainties. Well, like we just mentioned, a couple of stocks that are making all of the moves. Look at some of the auto ancillary names. Bharat Forge, Motherson Sumi, some of the stocks that are doing very well in the session. Even a name like Vikram Solar came out with a strong set of numbers. That particular stock too doing quite well. And the entire mid-cap IT space. So what actually transpired overnight was that Oracle Financial, the US-listed entity, actually went ahead and gave a very strong guidance as far as the rest of the year is concerned. The Indian-listed entity, which is OFSS, that has surged in trade, taking along with it some of the other names, some of the mid-cap IT names, and clearly the sector today and the number of stocks from the mid-cap IT space are doing very well. But Sonal has hopped across to the wall. This is our special segment, Mid-Cap Movers. Sonal is by the wall to take us through the mid-caps that are moving around in the session.
Oh, yes. So I thought let me talk about some stocks which are bucking the trend in terms of movers. And let me start with Indocount. Of course, we've been speaking about the textile stocks being in focus. This stock is up around 20% as we speak. MIC Electronics, this particular one has been buzzing off late, and that continues to be the case today as well. 7.5% higher there. Himadri Chemicals, NMDC Steel, and Enviro Infra, an interesting uptick there that has come by. So that stock is up around 4.5%. On the losing side, though, we do have some names which had been buzzing off late, so they are seeing some profit booking and on the back of some news updates as well. So you have Precision Camshafts. Now remember that stock had been buzzing on large volumes in last couple of trading sessions, so there is some profit booking that has come by there. Lakshmi Organic is the other one, which is down 2.5%. Swiggy too not doing so well, so 3% gone there. So I thought we'll talk about some stocks which have not been spoken about since morning, and these are some of them on my radar today.
Well, thank you so much for joining us and telling us about some of the stocks that are seeing some negative developments as well, and also some selling pressure emerge. We'll now slip into a short break. We'll get you more on the market, stock-specific action, and important corporate conversations on the other side. Stay tuned.
At this point in time, it seems to have emerged as a three-horse race.
Every one of us probably has grown up on a Parle or a Cadbury or a Surf, right? And then you realize that you are one amongst them.
You're the Parle and Cadbury of this
just
generation.
Swiggy is a verb
Yeah.
in many parlances.
What is the dream 5-10 years out for Swiggy and for Instamart?
100 million people coming to our platform and transacting 15 times.
Now, what would you consider as the big pain points?
There are a lot of flirters in our quick commerce business.
What are they flirting with you for?
They come for Rakhi, right? I think compared
And
to
then
last,
forget about you.
not forget, they still come back, but they have not transferred all of their buying onto Instamart.
Welcome back to Midcap Radar. Well, without wasting any time, Inox Wind is the first management on our radar. We've identified 3 key talking points with the management. First up, we want to understand what will be the impact of the GST reduction of solar value chain. Secondly, the company has had the confidence to go ahead and upgrade its EBITDA margin guidance for FY26. And we also want to understand the impact of the conclusion of the rights issue on the company's balance sheet. Devan Jain, who's the Executive Director at the Inox GFL Group, joins us now to discuss more. First up, Devansh, thank you so much for joining us. It's been a while. Q1 concluded a while ago, but we believe you were in the silent period due to the ongoing rights issue. Well, first up, before we get to that, we want to understand from you FY27 execution target, FY26 execution target, and what made you upgrade the EBITDA margin guidance? Devansh, I believe you're on mute.
Hi, Vivek. Can you hear me?
Yes, we can.
Good to see you. It's been a while. Was prevented by the bankers from getting on television, given our ongoing rights issue. But coming to your point, I think our guidances have been fairly clear. We've guided for about 1,200 megawatts in FY26 and 2 gigawatt plus for FY27. For 26, that's a 70% growth year on year. And for 27, that's a 67% growth on year. As you know, we've ramped up operations tremendously over the past 2 years since the turnaround of the entire sector. And I think we sit on a very, very solid order book of about 3.2 gigawatts at this point in time, which gave us the confidence to further upgrade our EBITDA margin guidances. We had achieved for the full year last year about 21%. We had guided for about 17 to 18%. And what we've done now recently, we've upgraded guidances to 18 to 19% for the full financial year FY26. We've taken a couple of actions over the course of this year. We've operationalized a new nacelle plant in Gujarat. We've started our own crane operations, and we've also started our own transformer manufacturing operations. Things put together give us the confidence to guidances which we're setting out.
All right. So, Devansh, you have things in place or processes in place to achieve the guidance that you've upgraded already. The new kicker that has come in has been in terms of GST cut that we've seen in the renewable space. Can you explain to us what the impact could be on the entire supply chain, and if that in turn benefits your group overall as well?
I'm very thankful to Modi ji and Nirmala ji. I think it's a game-changing move, which has been done ahead of schedule. Having said that, what that does is basically reduces the cost of energy. So power was not part of GST, and effectively we had no pass-through mechanism. Effectively, by reducing GST from 12% to 5% on the goods being supplied, we've cut down cost of renewable energy by broadly 5 to 6%. And I think everybody's capital costs are going to reduce to that extent. Obviously, for a company like Inox Wind or Inox Solar, we don't increase profitability, but it enhances execution, enhances faster or larger supplies of capital goods in the market. From a group perspective, given we're setting up a very, very large renewable energy IPP arm, it reduces capital costs for us drastically, and which we'll pass on in terms of reduced cost of energy or faster and larger execution targets.
Right. Devansh, you spoke about capital costs. First thing what we want to understand is how has debt moved post conclusion of the rights issue? What is the total quantum of the rights issue? We understand that there was a certain proportion of debt that was owed to the promoter entity that had infused capital earlier. So has that been extinguished? And we also believe there have been a couple of rating upgrades. So what will be the cost of capital for you going forward?
Look, so first and foremost, with respect to the rating upgrade, we've just been upgraded to AA- for our long-term banking facilities. Our short-term facilities are A1, which are the highest short-term ratings. And I think AA- reflects very, very strong financial profile, which will enable us to further reduce our financing costs, BC charges, LC charges, BG charges. Obviously, enhances confidence across investors, across asset owners, investors, bankers, and so on and so forth. I think what we had done is in our rights issue, which was 1,250 crores, about 560 crores was used to redeem the non-convertible redeemable preference shares of the promoters. But the promoters participated 100% in the rights issue. So the 560 went to the promoters, but the promoters reinvested that 560 in the rights issue. So it was kind of cancelled out each other's, but it strengthened the balance sheet of Inox Wind tremendously, because earlier that was debt which goes out, and that 560 has now become equity on the books of our balance sheet. Plus we got an incremental 650 odd crores across various other investors. So our liquidity at Inox Wind has become very, very strong. We're obviously a very large net cash company at this point in time. And I think we have the confidence, the mind, and the financial wherewithals now to not just scale up Manifold, which we've guided for, but also look at other opportunities.
Oh, interesting. A lot of transactions there to get to that net cash levels that the group has reached. Devansh, I wanted to understand how are demand trends panning out now in wind power? How's the bidding? What would the IPP demand trends be? And the outlook here as well.
Look, so maybe on the outlook side, we would expect, the Indian market to be about 5 to 6 gigawatts this year, moving to about 7 to 8 gigawatts next year, and then possibly stabilizing at about.
Devansh, I think we've lost connection.
Yes, it looks like we are not able to hear Devansh currently. We'll try to patch that connection back, but for now, we'll do one thing. We'll slip into a short break, and when we come back, we will talk about more in terms of markets and stock-specific action as well. So stay tuned for that. Welcome back. You're still tuned into Mid-Cap Radar. Let's talk about the real estate sector now. There's an interesting report which has come by from Knight Frank. Redevelopment projects are on the rise in Mumbai, and in their latest report, they indicate that these projects could unlock nearly 326.8 acres of potential land area in the city. To discuss more, Ghulam Zia from Knight Frank is joining us now. Ghulam, good afternoon. Thank you so much for joining in. Well, we know now Mumbai cannot expand horizontally. It has to be developed vertically, and the only way to do that is redevelop the entire city now. I wanted to understand, we've been seeing this from 2020, the big surge in redevelopment. Which phase of that cycle are we in? Do you think we've peaked out? Because there have been some conversations that indicated that maybe there have been some issues that builders are facing in terms of bidding very aggressively, and that is something which could impact the market overall in terms of growth. What's your take?
Well, absolutely bang on. The point that you made is exactly what we are trying to convey through this report to the masses, that the situation is a little scary. We are reaching a position where the promises made by developers to the existing society tenements have reached a certain situation where, if at all, market has to turn, because we're talking real estate is a cyclical scenario. So we already had 3 to 4 odd years of an up cycle already behind us. So I don't know where will we hit that peak point, after which there would be a slippery wicket. And if at all in next times to come, a year or two, please understand, once you sign a DA, you take at least 4 years to 4.5 years to finish the project. So if at all there is any change in the cycle, then the feasibility of the whole project can go for a toss, and we are reaching that scary situation. That's what we are trying to convey through our report today.
Right. Ghulam, so you're giving, moderating expectations as far as both buyers as well as developers are concerned. We want to understand, developers. Number one, they give increased carpet area. Number two, they actually pay for rent, especially when it comes to redevelopment. So overall, P&L, what is it that they can actually expect to make from the projects? They do increase the number of flats, but what kind of margins are they working with?
See, first of all, to put it across, it's, the biggest aspect that they're giving. The big cost is to take care of the tenements, to give them the additional area that you spoke about. They also give a very large corpus that is even bigger than the rents that you're talking about. So there's a corpus for these guys to maintain their societies in future. So extra area, corpus, rent, these are all costs that go towards the existing tenements. And of course, creating the supply, overall cost of construction, approvals, and this and that. So net, on an average, we are looking at about 20% as the return for the developer in this whole game.
Okay, so, from the P&L understanding, of course, costs are higher. But at the end of the day, is it capital efficient generally, Gulam? Because when we had conversations, a lot of listed builders are actually looking at redevelopment as a big opportunity. What do you have to say about that? Is this something that the stock market should be worried about that as well if they expand that portfolio?
Well, first of all, look at it this way. The big players or the developers that we're talking about have a bottom line, a benchmark below which they don't touch. So typically they're talking about projects which are giving them minimum 1,000 crore of a top line is what they enter into. But then otherwise, overall, it's such a large market. There are a few players who are catering only to this segment. Now, your problem, like if I talk about a problem from the tenement perspective, it's not really that huge a cost that you require to spend over here compared to a greenfield project. For buying a land, you're paying huge amount of money upfront. But in case of a society, because you're giving them right now only the corpus you are setting aside and rents is what you're giving them. So you actually have much easier cash flow to start with because your initial cash flows are much lesser compared to buying a land and developing it. So net, this is a great avenue. This is a good way for any developer to participate into. And obviously with the listed players also coming in, we do see a good a P&L or a new business emerging. However, as I said, the challenge is it's become so competitive that if you're promising moon to the developers, the chances that you will fall flat on your face is higher. So right now, the need of the hour is to leave something on the table, leave some cushion. If at all market turns, you are well taken care of.
So is it, from a consumer viewpoint, if somebody is looking at their building getting redeveloped, so they should be cautious as well, according to you?
Indeed. Look at it this way. Today, the moment you are giving your keys to the developer and developer has demolished your building, you are at his whims and fancies, at his completely going by what he's doing. So tomorrow, if at all markets turn and he has promised you a very huge promises are made, the developer may run away. And in that case, you'll be left high and dry because all you know, the next year's rental may not come. They normally give you every year's rental en bulk. So the next year's rental may not come and your house is gone. So extremely scary situation for the tenement owners who are giving their keys to the developers to be very sure that it's a very, very credible developer they are tying up with. Otherwise, it's a very scary situation.
Understood that. Gulam, would you agree? There's a lot of noise, especially when it comes to social media, about select markets of the country, especially when you look at the NCR region. Prices are moderating. Most of the flats have been bought by people not really looking to live, but rather, investors. And also South Indian market. Do you think there we've reached an oversupply situation?
Well, first of all, let's talk. We are sitting in Mumbai. Let me talk about Mumbai. At least Mumbai is not showing any such sign. Month on month, we've been watching, and even the August data is barely a percentage or two less than YOY last year's August. July was the same. June was better. And YTD in Mumbai, at least, we are still 11% over the last year's numbers. So net, Mumbai is defying all those talks that you're talking about. But Delhi is definitely gone slower, and Bengaluru. Hyderabad and Chennai are doing better. In fact, Pune is doing exceptionally well. So Mumbai and Pune are the two markets which are actually defying those the points that you're raising. Otherwise, yes, Delhi is a market to be worried about, and so is Bengaluru.
Gulam, just to follow up on that, because I was having conversations with some other analysts as well, the indication was because of the fear around IT sector, there's some pressure coming in Hyderabad and Bengaluru both, but you are suggesting otherwise. Is that pressure coming only in the unlisted space and the bigger players are able to continue their business as is, especially in Hyderabad and Bengaluru?
Well, as I said, Bengaluru is facing the heat right now. Bengaluru is going through some slowdown. Hyderabad is not yet. Maybe in times to come, the situation may change in Hyderabad. Chennai was always a smaller market, so it continued to perform the way it was, in fact, doing better than what it was doing earlier. Pune is, of course, another IT market, but Pune is not entirely depending on IT. It is also largely manufacturing, automobile and pharma, etc. So Pune is a different market, but only IT-dependent markets. You're talking about Bangalore is showing signs of cracks already. Hyderabad has been doing well, but we need to wait and watch.
Okay, thank you so much, Gulam, for joining us, giving us a sense of how exactly the redevelopment market in Mumbai is going and giving us a slightly cautious view, especially when it comes to consumers in terms of giving up their buildings in hopes of a bigger space. Well, coming back to the markets, have a look at the mid-cap index, continues to move quite high, 0.8% higher. A couple of stocks on the radar. Have a look at credit card player, SBI Cards. That particular stock has moved near the day's highest point, doing quite well throughout the trading session. That's doing quite well. The other one on the radar is Fortis, especially in the last half hour. That particular stock has moved quite high. And the entire insurance pack, after a couple of sessions of significant weakness today, has seen a bit of an up move. Names like HDFC Life, SBI Life, those stocks are doing quite well in the session today. But with that, it's all the time we have on this edition of Midcap Radar. Your stocks when we return.